than 40,000 people till now for investors in equities and options. The mission of FinIdeas is providing transparent solution to everyone for achieving financial freedom. And the vision of FinIdeas is FinIdeas will manage wealth of rupees 6,000 crores and serve HNIs and members of exchange globally by 31st March 2023. We are already located in these three countries, India, Dubai, and USA, and these cities. So if you want to have local support from these locations, you can get it, my dear friends. During this lockdown, we have done around 125 plus webinars, and we have got around 22,000 plus registration for that. And we have added around 32 crores fund during this lockdown period. My dear friends, the main purpose to show this slide is to make you understand that if we can use technology properly, it can make wonders for us. Now we are coming up with the new product for US market, and that is the index long-term strategy for US market. We are already doing this strategy since last 2.5 years. Whenever we are talking about investment, first we need to understand that why people are investing money in properties. So when we invest money in property, we normally get two kind of confidence that property doesn't become zero and sooner or later it rises. But when we invest money in equity, at that time we don't get that kind of confidence from equities. Because if we select some wrong stocks, our money can become zero also. So indirectly, we are having high risk as well as high return profile in equities. My dear friends, we were not interested to take that kind of high risk. So we have decided to take two actions. Action number one, that we are not going to trade in individual equities. That means no Apple, no Google, no direct shares. So where are we going to invest? We are going to invest in indexes. So what exactly the indexes are? In US market, we are having NASDAQ. The meaning of NASDAQ is that NASDAQ is the average of top 100 stocks of US as far as technology stocks are concerned. So that indirectly means that today we are having Apple, Microsoft, Amazon in all these stocks in NASDAQ. But as soon as those stocks reaches to 101 number, it will automatically move out and some new stocks come in. So that indirectly means that if we are having the combination of top 100 stocks of US market in NASDAQ, so indirectly NASDAQ is giving us the surety that it cannot become zero, my dear friends. So the first confidence what we are getting from the index, that index can't become zero. Now the next point, the valuation of Apple before some time was around 1400 billion. Microsoft was having the valuation of around $1,300 billion. So if I add the 100 stocks market valuation, it was around $13,000 billion. And this 13,000 billion was equal to 10,000 NASDAQ level. My dear friends, now I am having the super smart question for all of you. The question is that if the richest company of US market today is having the valuation of around $1,400 billion, so the futuristic company, the top company of US market after 5 years, 10 years, 15 years, 20 years, logically it should have the valuation above $1,400 billion. If it will be above $1,400 billion in future, then automatically the top 100 stocks valuation will be about $13,000 billion, and accordingly the index will be about 10,000 level. What exactly the learning is? The learning is that the confidence what we are getting from property, that it cannot become zero and sooner or later it will rise. Both the confidence we are getting from the index of that country, because index is the average of top 100 stocks of the country, so it cannot become zero. And because it is directly related with the market capitalization, so sooner or later it will rise. The next point what we can understand from here is that how equity plus safety can create prosperity. So my dear friends, first we are going to buy the index. Suppose NASDAQ is running near to 10,000. So we will buy NASDAQ by paying $10,000. And simultaneously we will buy the protection against downfall. if we compare the data of past 6-7 years, we are getting Nasdaq put option, annual put option near to 6% a year. So that means we need to invest $600 to protect this $10,000. So our investment instead of 10,000 has reached to 10,600. But simultaneously, we have got the surety that if because of any reason market falls down, then our $10,000 are protected in any condition for full 1 year. That indirectly means that if I invest $100,000 in US market, then my $100,000 can never go below $94,000 in any case during the complete 1 year. So this is the good point. Now the negative point toward this strategy is that if market remains at the same level, then we can lose money. Suppose in 2020 index is running near to 10,000, and after 4 years at 2024 index is still at 10,000. So in this condition, we may lose the premium what we have paid against the protection of this portfolio. In between 2021, 22, 23, market has gone up from 10,000 to 12,000, but again it has fallen down to 8,000. Again it has moved up, and again it has fallen down. Now suppose I have invested $100,000 over here, so I will pay $6,000 against protection. Next year market has gone up. It's a very important slide. It will give you the clarity that how the protection is not the cost for us, rather it can create a lot of opportunities for us. So next year market has gone up from 10 to 12. So indirectly market has gone up by 20%. So our $100,000 will become the portfolio of $120,000. We are going to earn $1,400 over here. Why? Because $6,000 we have paid against the protection cost. So net $14,000 are the profit for us. Next year we are going to take the protection of $120,000. So that means I need to invest $7,200 against the protection. And market has fallen down from 12,000 to 8,000. My dear friends, the beauty of this strategy is that when market has fallen down, your portfolio of $120,000 will remain constant. How it had happened? Logically, when market had fallen down by 33%, your portfolio must have become $80,000. But the difference of loss, what you have incurred in the valuation of your portfolio, that you are going to get back from the put option, what you have purchased. So again, you are going to get $40,000 from put option. You will reinvest those $40,000 at 8,000 rate. So indirectly, your number of equity will rise and your portfolio will remain constant. Again, you need to pay $7,200 against the protection cost. Next year, market has gone up from 8,000 to 12,000. So that means market has gone up by 50%. Your portfolio will also rise by 50%. So your portfolio will reach to 180,000. What exactly the learning is? The learning is that whenever market is moving up, we are also moving up. But whenever market is falling down, we are not falling down. And just because of this reason, in longer run, we are outperforming. Again, you have paid the protection cost. Next year, market has fallen down, but your portfolio will not fall down. So in 4 years, the 10,000 index is still retaining at 10,000 only. But your portfolio of 100,000 has become 180,000. You have paid 10 plus 7, 17 plus 7, 24 plus 6, $30,000 against safety cost. So instead of 180,000, you are going to get 150,000. But the fantastic learning is that market remains same, but still you have grown. Why? Because you have taken proper protection. So whenever market has fallen down, your portfolio has not fallen down. And next year when market has recovered, you have gained. This was the hypothetical data, my dear friends. So we will see the real data also later on. Mr. Warren Buffett, he is concluding his investment strategy in these 2 lines only, that there are only 2 rules of investment. Rule number 1, never lose money. And rule number 2, never forget rule number 1. So the person who have made billions of dollars from stock market is concluding their line that we should never lose money. So that indirectly is the message for us that it is very important for us to protect our money. Now, if we want to use all these learnings in practical market, how we can do? So my dear friends, suppose you want to make the portfolio of $100,000. So what should you do? You should invest only $50,000 to make the portfolio of $100,000. So $50,000 you are going to invest, you will buy the index ETF of $50,000. You will put them as collateral. On the margin of that collateral, you will buy the index futures of that 50,000. So indirectly, you have made the portfolio of full $100,000. Your intention was to make the portfolio of $100,000. You have made the portfolio of $100,000 by just investing $50,000. Now, rest amount. So, as you have made the portfolio of $100,000, so if market moves up, then you are going to earn on 100,000. If market falls down, then you are going to lose on 100,000. I don't want to lose on $100,000, so I will buy the protection. By investing just 6%, just $6,000, I will get the surety that now if market falls down, then my complete $100,000 will remain protected. So my portfolio will not crash. The second cost is the financing cost. As in US market, we are having very low interest rate. So the financing cost is around 0.5% a year. So that means that on $50,000, the futures, we need to pay 0.5% a year. So indirectly $250, just $250, we are going to pay. And by paying this $250, we are getting $50,000 for a year. So indirectly, our total cost is $6,250. So the $6,250 is giving us two protections. The first one is the protection against the market downfall. And the second one is the financing benefit that I have invested $50,000 while I'm going to earn on full $100,000, my dear friend. So indirectly, you have taken two benefits over here. The first one is that you are protected now, downside. The second one is that you have added the extra advantage of leverage over here. So now if we conclude this conclusion by looking at the calculation of past data, in last 17 years, index of 984 Nasdaq has reached to 8733. So around 9 times. While the investment of $50,000 have reached to 5,51,000, so around 11 times. Now the second point, that whenever market is rising, so market has gone up by 49%, you have earned 81% because you have invested just $50,000 while you have made the portfolio of $100,000. So you have earned on $100,000. So if you compare the returns on 50,000, it will be almost double. But whenever market has fallen down, your max loss was around 17-18%. That was your maximum risk because you have invested $50,000 only. And on those $50,000, you were having the risk of 6,250 or with some advisory fee. So around 17 to 18% is your maximum risk. So if we conclude the figure of last 17 years, we can see that almost 15.20% annualized CAGR you have generated. So if we can compare the last 17 years data, in last 17 years, index has gone up by 13.7% CAGR. While people who have invested money in this kind of strategy, they have generated the return of 15.20%. So returns are higher. On second side, index has shown the risk beyond 40% a year, while you have never witnessed the risk beyond 18%. So you have reduced the risk as well as you have enhanced your returns. So my dear friend, the basic learning behind this strategy is that you can reduce your risk as well as you can generate high return. So people who are saying that higher the risk is higher the return, we don't believe in that. We believe in that smart calculation generates high returns. And here you have taken two smartness. Smartness number one, always trade in index. Smartness number two, always take protections, because protection doesn't cost you in longer run. My dear friends, now the next question is that what will be the minimum investment over here? So the minimum investment is just $12,500. You can start with one lot. The size of one lot is around $25,000. We need to invest only 50% in this market. So that means by investing $12,500, you can start this kind of strategy. What will be the commercials? So half yearly AMC fee is, if you are making the portfolio below $100,000, then just 0.75%, means 75 basis point is the fee for half year. When your portfolio reaches to 100K, then this fee will get reduced to 0.625 basis. And when your portfolio reaches to $1 million, then your fee will reduce to just 0.5% for 6 months. So this is the commercials what FinIdeas is charging against the handling of this complete strategy. Friends, if we can compare the complete strategy with equity, mutual fund or PMS investment, so if I want to invest $10,000, so in equity, I'm going to invest 10,000. Here also we can make the investment of 10,000. Here on the basis of 10,000, we can make the portfolio of $20,000. If market moves up by 100%, then here my 10,000 will become 20,000 in equity, mutual fund and PMS. While in index long-term strategy, my 10,000 will become 28,600. If market falls down by 50%, then my 10,000 will become 5,000 in equity, mutual funds or PMS. While in index long-term strategy, my 10,000 can never go below $8,600. So my dear friends, you have reduced the risk as well as you have enhanced the returns, and simultaneously your investment is same in both the things. So what exactly the overall features are? The overall features are that this is the combination of equities and futures. This is the combination of debt and equity. It is having limited risk downside. The complete fund flow is managed over here. This is the index-based strategy. So that is why we are having low risk downside. We are having past track record. That is the very super strong past track record. People can see their live accounts because we are having the complete back office with us. There is no lock-in period. Whenever you want to enter, you can enter. Whenever you want to get out, you can get out from the investments. But still the logical period of investment is around 5 to 10 years. Friends, we are having the dedicated team for this. They can help you for the real-time advisory. We have the complete systematic trading through algorithms so that we can advise you with the speed, accuracy, and consistency. And you can plan your retirement or higher education from this kind of investment, because ultimately you are having limited risk profile and simultaneously you are investing your money in index. So you have low risk. And finally, the golden line is that all the trades are going to happen in your own account. So you don't have to put your money to somebody else. You can keep your money. You are going to keep your money in your account only. My dear friend, that I hope that you must have liked this idea. If you want to know more further about this, then you must have got the link on chat. Kindly click on the link and fill up your form. As soon as you will complete your KYC, then we can advise you personally that how you can move ahead. So you need to just give the basic information over there so that our team can get in touch with you for further assistance. Till 31st December, there is no token fee for the KYC. So you can have your KYC at free of cost. As soon as your KYC will get done, immediately you will get one relationship manager from FinIdeas. You will get your own back office to test your strategy over there. My dear friends, I hope that you must have liked this idea. If you like this idea, then I advise you to just give us a small review. So you have got the review link. You can give the small review to us. We will be very happy to read your reviews. My dear friends, if you have any kind of questions, you can ask us. We will be happy to give you the answer of your query. For further assistance, you can get in touch with us at 919374985600. So you can send us WhatsApp message. Our team will get in touch with you. So I will be very happy to give you the answer of your questions if you have any kind of queries. Once again, on behalf of FinIdeas, myself, CA Govind Jhanwar, I am thankful to all of you for coming over here and attending this webinar. This will give an extra edge to us to invest money in US market. US market can give us good growth with the protection of fund. These kind of strategies are good for people who are residing at US and who are having the access to US market. People who are from Indian origin or Indian resident and staying at India only, we advise them to invest money in index long-term strategy of India. That means on the basis of Nifty. So for Indian people or Indian resident, it is advisable to trade in Nifty index, while people who are residing at US and are having the complete access to invest money in US market, it is advisable to invest money in Nasdaq market. Once again, on behalf of FinIdeas, myself Govind Jhanwar, I am thankful to all of you. Bye bye. We'll meet soon. Get in touch with us. You can fill up the form so